business sentiment. And in particular, your blue line there is the National Bank's monthly business outlook survey, activity expectations. Businesses are asked, do you think you will be busy in a year's time? And so there's your blue line, and note how the far, what are we looking at, right-hand side, it's been tracking at reasonably high levels over the past couple of years, well away from the lows of early 2009. Okay, so that's how businesses think they're going to be busy, and it's in good territory. The orange line there is the rate of growth in our economy. Now, the key point to note here is that up until early 2009, they tracked broadly in the same territory. That's not a quarter or year-on-year correlation, but they're in the same zone. Not since 2009. A disconnect has opened up, a structural change has occurred. Opened up between what businesses say they expect to be doing and what they do about it. In the past, businesses would say, I'm going to be busy, so I'm hiring people and I'm investing and I'm building up inventories. Not now. Businesses are saying, yep, I'm going to be busy in a year's time, but I'm going to wait and see what happens. That is the dominant theme. We find it ourselves in the BNZ in terms of companies that are signing up the loan documentation for purchasing new equipment from overseas or whatever, but not drawing down the line of credit, not activating it as yet. They just want to wait and see what happens in Europe when the farmer spending comes along, when the rebuilding of Christchurch gets going. And there's no shortage of reasons for waiting and seeing at the moment. So this is quite important. I think a few other forecasters have missed this change, and they're looking at these traditional measures of where the economy's going and have been continually overestimating what the strength in our economy will be. We think differently these days. We may say we're happy, but we don't go and buy the ice creams like we would have in the past on that basis. Okay, so why? This is what we get into. So that was the first list there of sort of good stuff. Now, why aren't we in fact expecting to see the economy jump up by 5%? Why has the recovery in the economy been so muted so far? So, in no particular order of importance, this is what we've got here. Number one, you're deleveraging. We are paying down debt. The story of the world from the 1980s through to 2007 was money increasingly available around the planet, made readily available by different groups of investors, be they the petrodollars out of the Arab countries from the late 1970s, be it the current account surpluses being recycled out of China and Asian countries, Japan, etc., during the 80s, 90s, the 2000s, whatever. Money was made available to the banks, and if banks can easily borrow money, the risk is they lend it out on the other side. And so we've seen a lot of credit being readily available. People have built up big debt levels. Now they want to pay down that debt, as I was mentioning the numbers on US household debt, etc. earlier on. And the key point to note here that I've been making for, I don't know, maybe the 2 or 3 years, nobody on the planet has an economic model that says when you come this close to almost a Great Depression, this is what usually happens afterwards in our tolerance of debt. It usually takes X quarters before we get happy about debt levels and start spending again. We're only building up one data point towards answering that question at the moment. And so this is just a complete guess, a complete suck it and see exercise as to when people generally in Western countries are going to feel it's okay and start doing some increased spending, businesses doing more borrowing and investing, capital raising or whatever. At some stage, we're going to wake up of a morning and feel happy, and boom, it starts happening. It could be 10 years down the track. So, complete unknown, basically, that one. Second one there, of course, why isn't the building shooting off in Christchurch at the moment? Well, a couple of reasons, and all stems from the first one. The shakes are continuing. The aftershocks are still coming about every 3 to 4 months. And while the aftershocks are continuing, the insurers are not willing to come forward with the insurance until they can more accurately price what the risk is. I mean, if you know what the risk is, you can price it. It may be a high premium, but, the insurance companies, I have no doubt, will come forward. But at this stage, they're not really certain what the degree of risk is of future, aftershocks and the damage they're going to do and have all the faults stop moving. I've got 3 acres in marshlands on the northeast outskirts of Christchurch there, and for my bit of land, no problem. We had one little sand volcano there, the house, a wooden thing. It's all relatively fine. And if I say that in front of people from Christchurch, they just say, your fault hasn't moved yet. That's all. Your turn's coming, smart ass. So the confidence isn't there that the whole thing has ended. And there was something I skim-read offshore about 2 weeks ago about decades of aftershocks of a certain magnitude continuing in Canterbury. Okay, so if at some stage the insurance becomes available and then we can get the house building kicking off. But for the moment, it really isn't, and so people can't really do too much about it. We haven't had too much growth in incomes recently. If you're in the finance sector, you might have had a wage increase if you're lucky the past 4 years. Yeah, 1%. Woohoo. So there we go. So real income growth is relatively weak out there at the moment. Households are constrained in their budgets, and what I could have whacked right beside that would be cost of living increase. Cost of living change is the same thing as inflation. It is the definition of inflation. And this, I think, is what a lot of people have missed over the years when they've said, all our economy needs is a bit more inflation just to grease the wheels and it's okay. Inflation means that instead of household prices rising 2.5% over a 1 year period, the cost of living, it rises by 5%. So you've got extra increases in your rates, in your insurance premiums, in the TV cost or whatever. And of course, unless your household budgets are rising the same amount or more, real purchasing power of your consumers is going down. High cost of living increases, high inflation actively denudes spending in the economy, after a bit of a lag anyway, but it takes away spending power, and this is what's been causing weakness in many economies around the world. And for us in New Zealand, we watched the price of the cheese going up earlier on, and so we pulled back on buying there. We still want to buy some cheese, so we cut back on spending on something else, etc. Government tightening fiscal policy, it's looking to get back to surplus by the middle of 2015. There's a reasonable chance that they will do it, but especially overseas, of course, this is happening in spades as rapidly as they can. The Kiwi dollar might be low against the Aussie dollar, but we're relatively high, and a few months ago we were at 3-decade highs against the greenback, against the pound, etc. So I completely depressed 250 people in one audience I was talking to in London there 3 weeks ago with my view that if things settle down in Europe, you're looking at 55 pence to buy some Kiwi dollar, one Kiwi dollar in the near future. Of course, I'm talking to a room full of people who went to live amongst the palms there for a while to make a bit of a nest egg and one day go back to New Zealand and I keep saying to them, well, you should have moved your money when we hit 34 pence in April 2009. Yeah. So a lot of people are not too happy, and the numbers coming to New Zealand from the UK have dropped away quite substantially over the past 2 to 3 years. Anyway, we're high against these other currencies, so that can crimp into the export competitiveness for New Zealand companies. I've mentioned, obviously, some of the worries abroad, which are just going to continue for don't know period of time. And the net migration is below average. On average, we get a population gain from migration flows of 16,000 people per annum. We're running at 773 in the year to September. So it is below average. And that big change comes about not so much from fewer people coming into New Zealand, but a massive surge in the numbers going out. In the past year, the number of people coming into New Zealand has increased about 2%. The number of people going out is up about 23%. A massive surge in the numbers going to Australia. We see Kiwi low against the Aussie dollar. All we do is convert the Aussie wage into Kiwi dollars, not the house, the car, or anything else, and boom, we're out of there to live like kings across amongst these bloody Aussies across there. So, we see that. The unemployment rate in Australia is lower than here, and that is a traditional driver of people going out. And also, a lot of people who were going to go to Australia in 2009 into 2010 didn't sat still, see what was going to happen. We've got a catch-up period of those people hopping across there at the moment. So on average, each year we lose a net, not gross, but net 20,000 people to Australia each year. We're running at about 33,500 net loss at the moment. The record is about 35,500. We're probably going to exceed that in the next few months. So that's what's moving us going to Australia, is the beastie there.